$600 billion. That was the size of Lehman Brothers when it collapsed. A 158-year-old Wall Street giant did not slowly fade away. It broke fast. And when it did, fear spread through the entire financial system. Banks stopped trusting banks. Markets froze. Panic moved around the world. This was not just one company failing. This was one collapse exposing how fragile the whole system really was. So how did a firm that old, that powerful, and that connected fall apart so completely? This is the story of Lehman Brothers. Section 1. The image of strength. For years, Lehman looked like a serious, established Wall Street institution. It had history. It had scale. It had prestige. To the outside world, Lehman was not some reckless startup making wild bets in a garage. It was one of the biggest investment banks on earth. That image mattered. Because when people see age, size, and reputation, they assume stability. They assume discipline. They assume somebody important is in control. And that is what made the collapse so shocking. Lehman was deeply tied to the mortgage machine that had been driving profits across Wall Street. The housing boom had created a powerful illusion. Home prices had been rising. Mortgage-related products were making money. Executives across the system convinced themselves that the machine could keep going. As long as housing stayed strong, the model looked brilliant. Profits came in. Risk looked manageable. Confidence kept building. But under that confidence was something much more dangerous. Lehman had loaded itself with exposure tied to real estate and mortgage-related assets. It was doing this with enormous leverage. That is where the real danger begins. Section 2. The real problem. Leverage. Leverage is simple. It means using borrowed money to make your bets bigger. If things go well, leverage makes profits look amazing. If things go badly, leverage can destroy you. That is exactly why leverage is so dangerous. It makes good times look better than they really are, and makes bad times deadly. Lehman was not just making housing bets. It was making very large housing bets while depending heavily on borrowed money. That meant it did not have much room for error. When the value of those assets was high, Lehman looked strong. When the market began to crack, that strength started to disappear. Because the problem with borrowed money is that confidence matters. The system works as long as lenders, counterparties, and investors still believe you are safe. Once that belief breaks, pressure arrives fast. And in Lehman's case, that pressure was building while the housing market was getting worse. Mortgage defaults were rising. Real estate values were falling. The products tied to those mortgages became harder to value and harder to sell. Suddenly, the same assets that had once looked like profit machines started looking like toxic weight. Lehman was carrying too much risk into a market that was no longer forgiving. Section 3. It was not just losses, it was trust. A lot of people think collapses happen only because a company loses money. That is not the full story. In finance, trust is everything. A firm can survive losses for a while. What it cannot survive is a loss of confidence from the people funding it, trading with it, and watching it. And by 2008, confidence in Lehman was breaking. Investors started asking harder questions. How much bad real estate was Lehman really holding? How much were those assets actually worth? How exposed was the firm if markets got even worse? Those questions are deadly when the answers are unclear. The more uncertainty grew, the more dangerous the situation became. Because once people suspect the balance sheet may be weaker than it looks, they become more cautious. They pull back. They protect themselves. And in a highly leveraged institution, caution from others can become a death sentence. That is one of the most important lessons from Lehman. The collapse was not just about bad assets. It was about the market no longer trusting the institution that owned them. Once trust disappears, time disappears with it. Section 4. The fatal moment. By September 2008, Lehman was running out of options. The market knew the firm was under pressure. Its stock was collapsing. Confidence was disappearing. And leadership was trying to find a solution before the whole thing snapped. Possible rescue options were discussed. Potential buyers were considered. There was hope that some kind of deal could save the firm. But a weak company in a panic is hard to save. The numbers were ugly. The assets were questionable. The environment was chaotic. And no clean rescue came together in time. Then it happened. On September 15, 2008, Lehman Brothers filed for bankruptcy. That filing became one of the defining moments of the global financial crisis. Because once Lehman went down, the fear spread far beyond Lehman. This is where the story gets even bigger. The collapse told the financial world that a major Wall Street institution could fail suddenly and violently. That changed behavior immediately. Firms stopped trusting each other. Liquidity dried up. Credit markets seized. Everyone started asking the same question: who is exposed next? That is how panic spreads. Not just through numbers, but through uncertainty. If one giant firm can fall, then every connected institution suddenly looks suspicious. And when enough people think that way at the same time, the whole system begins to freeze. Section 5. Why this collapse hit so hard. Lehman did not become famous just because it failed. It became famous because its failure intensified a global crisis. This collapse became a symbol of systemic fragility. It showed what happens when leverage, weak assumptions, asset bubbles, and fading trust collide at the same time. And it revealed a brutal truth. A financial system can look sophisticated right up until the moment it stops functioning. That is what makes this story so powerful. The danger was not obvious to most people during the boom. In good times, leverage hides, risk hides, fragility hides. Everything looks efficient. Everything looks profitable. Everything looks modern and smart. But when the pressure arrives, hidden fragility shows itself all at once. Lehman was not the only problem in the system, but its collapse became the moment the system's weakness was impossible to ignore. Section 6. The psychology of the collapse. This is the psychology behind disasters like Lehman. People do not usually blow up institutions because they want to destroy them. They do it because success convinces them they understand risk better than they really do. When a strategy works for long enough, people stop seeing it as risk. They start seeing it as normal. Then they scale it. Then they defend it. That is how dangerous patterns become permanent. In Lehman's case, years of operating inside a booming market likely made extreme exposure feel manageable. The machine had worked before. The profits had shown up before. The market had rewarded aggressive positioning before. So the warning signs became easier to dismiss. That is what overconfidence does. It slowly converts caution into commitment. And once leaders are psychologically committed to the model, changing course becomes difficult. Selling weak assets feels like surrender. Reducing exposure feels like admitting weakness. Raising alarms feels like damaging confidence. So they wait. They defend. They hope. And hope is not a risk strategy. That is why collapses often look obvious in hindsight. By the time reality becomes undeniable, the institution is already too weak to recover. Section 7. Executive lessons. There are several hard lessons here. First, leverage is not strength. It can make performance look powerful, but it also makes survival fragile. Second, liquidity matters as much as profit. A company can look valuable on paper and still die if it cannot survive short-term pressure. Third, trust is a real asset. When markets stop believing your numbers, your options disappear fast. Fourth, concentration risk can kill even famous institutions. If too much of your fate depends on one theme, one market, or one assumption, you are not diversified. you are exposed. And fifth, reputation is not protection. Lehman had history. It had scale. It had status. None of that saved it when the structure underneath it weakened. That lesson goes far beyond Wall Street. Any company can mistake momentum for durability. Any leader can confuse recent success with permanent safety. Any system can look solid while hidden weaknesses are piling up underneath. Ending. Lehman Brothers was 158 years old. It was one of the most important names in finance. And yet, in September 2008, it collapsed into bankruptcy under the weight of leverage, bad real estate exposure, and vanishing trust. That is why the Lehman story still matters. Because this was not just a company that failed. It was a warning. A warning that size does not guarantee safety. A warning that markets can turn faster than leaders expect. And a warning that once trust breaks in a leveraged system, collapse can move with terrifying speed. $600 billion. Gone. And the panic that followed changed the world. If you want the next breakdown, subscribe. And if you want to understand the frauds, collapses, and business failures that looked unstoppable right before they fell apart, keep watching.